Hello everybody. I want to talk about exchanges of non-monetary assets. Okay, let's talk about what this is. Exchange of non-monetary assets. You guys might even had something like this in your own life. If you've ever purchased a new car and you have traded in an old car and maybe they've given you a trade-in allowance of this, well, that old car would be a non-monetary asset. And in a way, you're exchanging non-monetary assets. An old automobile in exchange for a new automobile. And you might have to pay some extra as well, but there is still an exchange of non-monetary assets. Now, we're going to account for these exchanges on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. Okay? Now, companies should recognize immediately any gains or losses on the exchange if and when the transaction has what we call commercial substance. That is a term that I want you to know. What is commercial substance? Okay, well, commercial substance exists if the future cash flows change as a result of the transaction. Or in other words, if the two parties' economic positions change. Okay, so they'll usually tell you this transaction has commercial substance or this one does not. They'll usually tell you that in your problems. But I want you to know how they are coming to that realization. If the future cash flows change as a result of the transaction for the company in question, then for that company the exchange does have what we call commercial substance. Okay, now, if the exchange has commercial substance, you will recognize any gains or losses immediately. No problems. Okay? Now, what if it lacks commercial substance? Okay? What if it does not have commercial substance? Well, you are going to recognize your losses immediately, but you will not recognize gains. You will defer your gains. Okay? Now, what if the exchange lacks commercial substance, but there is some cash received? Okay? There is some cash received by you. Okay? You're not giving cash to them, but cash received by the party in question. Well, then what you do is you receive what is called or you recognize a partial gain. And again, losses are always immediately recognized. Okay, but if the commercial lacks commercial substance, we have to step back and take a look at our gains to see if we recognize them or not. Most of the times we won't. Okay, once again, this goes to what I was just saying. Companies always recognize the loss immediately, whether the exchange has commercial substance or not. Okay, and the rationale is companies shouldn't value their assets at more than their cash equivalent cash equivalent price. We don't want to overstate our assets. So no matter if the exchange has commercial substance or does not have commercial substance, losses are always immediately recognized. Okay? All right, let's take a look at some examples, and I think this will be the best way to kind of clarify this stuff. Okay. Information Process Inc. trades its used machine for a new model at Jared Business Solutions. The exchange has commercial substance. Okay? It has commercial substance. So, if it has commercial substance, you can recognize either a gain or a loss if that occurs. The used machine has a book value of $8,000. Now that's the used one. Now remember what book value equals. Book value equals your cost less your accumulated depreciation. And they tell us these amounts. The original cost is $12,000. Subtract out the $4,000 accumulated depreciation. That gives you a book value of the old machine of $8,000. Now, the old machine has a fair value, that's more like your market value, of $6,000. Okay. The new model lists for $16,000. Okay. Jared gives information processing. Now, Jared is the person or the company we're buying it from. They give us a trade-in allowance of $9,000 for the used machine. Okay, so we need to compute the cost of the new asset. Okay, here's how we're going to do that. Well, the list price of the machine is $16,000. Okay, Now they're giving us a trade-in allowance of $9,000. So thus, how much cash do we have to pay them? We have to pay them $7,000. But we also are giving them our old machine or our used machine, and the fair value of that used machine is $6,000. Thus, the cost of the new machine, we're going to put that on our books. We're going to capitalize on our books at $13,000. Let's take a look at the next slide. Okay, so what we do here is I'm going to go ahead and put the whole journal entry, but I'm going to tell you the order I would put things in. Okay, first of all, I would say this. Okay, I'm paying out cash of $7,000. So that's probably the first thing I do in my journal entry. The other thing I'm going to do in my journal entry is I know I need to take the old equipment off the books. It had a cost of $12,000, and I know I need to take the accumulated depreciation off the books. So my second step is actually to take the old equipment and its related accumulated depreciation off the books. Okay? The next thing that I would do is, from the earlier slide, we determined that the new equipment would go on our books at $13,000. Okay? Well then, what we can do here is then figure out our accounting plug. And our accounting plug is whatever you have to do to make this journal entry balance. Okay? Now before we debited this loss, we had $17,000 on our debit side and $19,000 on our credit side. So the debit side needed $2,000. Well, whenever you have to debit either a gain or a loss, if the plug is on the left side, the debit side, it's a loss. If the plug is on the credit side, it's a gain. So since it's on the debit side, it is a loss on disposal of equipment, and we can immediately recognize that. Okay. Another way that sometimes they'll figure that up is they'll say, okay, the fair value of the used machine was this, the book value of the used machine was that, and that's another way of arriving at the disposal, the loss on disposal of the used machine. Okay. Now let's take a look at a different situation. All right. Okay. Let's talk about a gain situation when there is commercial substance. Okay, what we're going to do is, in this case, the company is going to record the cost of the new asset acquired during the exchange at the fair value of the asset given up. Okay, and we're going to recognize a gain, which we can do since the exchange has what we call commercial substance. In other words, the future cash flows will be altered. Let's look at the example. Okay, Interstate Transportation Company, that's us. We exchanged a number of used trucks, plus we give them some cash for a new semi-truck. The used trucks have a combined book value of $42,000, which is your cost of $64,000 less your $22,000 accumulated depreciation. Now, our purchasing agent, who's pretty experienced in the second-hand market, indicates that the used trucks that we're giving them have a fair market value of $49,000. Okay. In addition to the trucks, we also have to pay $11,000 in cash. Okay. So we're giving them our old trucks and $11,000 cash. Okay. So how do we compute the cost of the semi-truck? Again, remember, this transaction has commercial substance. Well, what's the fair value of the old trucks that we're giving them? It's $49,000. We're also giving them cash paid, or we're giving them cash of $11,000. Thus, the cost of the new semi-truck that we're going to put on our books is $60,000. Okay? So, let's record the exchange. Let me put it all up there, and again, let me tell you the order that I would do things in. Okay, I know I had to pay out cash, so I'm going to credit cash for $11,000. I know I have to take the old trucks off the books, both their cost as well as their accumulated depreciation. So that would be the second thing that I do. The third thing I do is I'm going to record the new truck at its cost that we determined from the earlier slide, and that was $60,000. Okay, now if I'm just looking at this, and this, I'm going to ask myself, does the journal entry balance? No, it does not balance with just those four items. Debits add up to 82, credits add up to 75. Thus, to balance this journal entry, we need to credit something for $7,000. Well, what do we credit? Well, we credit gain. Like I said, if the plug is on the debit side, it's a loss. If it's on the credit side, it's a gain. So we are going to credit a gain. Now we can do this because we have commercial substance. This transaction has commercial substance. Thus, you can recognize gains. If it has commercial substance, you can recognize immediately any gains or losses. Okay? All right. And then they kind of came up with this other way of computing the gain, but I kind of like the approach of building the journal entry. All right? So there's another example for you. Okay, what we're going to look at now is we're going to look at a situation that does not have commercial substance. There's no commercial substance and there is no cash received by us. We're the company for which we're doing the journal entry. Okay? Now, if a company lacks commercial substance, you cannot recognize a gain. You can recognize a loss, but you cannot recognize a gain if the transaction lacks commercial substance. Okay? And there's no cash received. Okay? So what we're going to do is we're going to assume that this lacks commercial substance. And let's see how we do this. All right? Okay. For example, Interstate Transportation Company, that's us, exchanged a number of used trucks, plus we give them some cash for a new semi-truck. The used trucks, again, have a combined book value of $42,000, which is the cost of $64,000 less the $22,000 accumulated depreciation. Now, Interstate's purchasing agent, who's very experienced in the secondhand market, indicates that the used trucks that we're giving them have a fair market value of $49,000. Okay? Now, in addition to the trucks, we've also bartered with them, and we have to give them $11,000 cash as well. So we have to give them these used trucks with a fair market value of $49,000, and we must also pay $11,000 cash to get this new semi-truck. Okay? Now, we're going to compute the cost of the semi-truck as follows. Now, once again, I want you to realize that this transaction lacks commercial substance. All right? So let's take a look. Okay, so in this case, which is the same instance as we did before, the fair value of the truck that is given up as well as the cash given is $49,000 plus $11,000 respectively. And so the truck would, as we did in the previous example, go on our books at $60,000. However, there's a problem here. This situation does not have commercial substance. Now, I want you to recognize something very important. This whole illustration that we're doing is exactly like the previous one back here, except this latter situation does not have commercial substance. This did, and this journal entry that we produced here, right here, when we had this exact same scenario, but it had commercial substance. This was the journal entry when it had commercial substance. But as you can see, when we did this journal entry back on, you can keep track of the page numbers down here, 1046, this had commercial substance, okay? This had commercial substance, okay? But what did we do when it had commercial substance? We had a gain that was recognized. But as I've said many times, if a commercial lacks commercial substance, you cannot have a gain. Okay? So let's say everything is the same except now let's go back to the situation where we lack commercial substance. Well, in that case, and I know I'm going to get a little messy here, you cannot recognize this gain. You cannot recognize a gain when there's no commercial substance and no cash that we received. So we have to scribble that out. So this side now equals 75. This side now equals 82. Here's what you have to do. You cannot record that truck at the 60,000. You have to record the truck at whatever it's going to take to balance out that journal entry. And in this case, I believe that is $53,000. Okay? You're going to have to kind of force that amount that you capitalize the new truck at for $53,000 because the journal entry needs to balance. Debits need to equal credits, but you can't recognize a gain. Now let's go back to where we were. Okay? They show you this in a little nicer form. Okay? Here is the same journal entry that we just looked at. But it's a little cleaner. But we got this 53,000 because we cannot recognize a gain if it lacks commercial substance and there's no cash received. All right? Hang with me, folks. We're getting there. Okay, now what if there's a gain situation, but once again we lack commercial substance, but this time we get some cash. We receive some cash. Okay? Now again, we're not talking about our vendor getting cash, we're talking about us getting cash. We're the company for which we're doing the journal entry. When a company receives cash, and sometimes they call that boot in accounting terms, what we can do is we can actually recognize a portion of the gain. Okay? Now, how do we calculate the amount of the gain that we can recognize? We take the cash that we receive, or the boot, divided by the sum of that cash received and boot added to the fair value of other assets received. Okay, and then we take that times the total gain and we get the recognized gain. Let's take a look at this. All right. Okay, let's say we traded in used machinery with a book value of 60,000. The cost was 110 less accumulated depreciation of 50. That's how we get that book value of 60,000, and it had a fair value of 100,000. Okay, it receives in exchange a machine with a fair value of 90,000. Now we also received cash of 10,000. We received cash of 10,000. Now in this instance, we can take a look at what our total gain would be if we could recognize it all. And that would be the fair value of the machine exchanged or given up, less the book value of the machine exchanged. So that number is 100,000 less the book value is 60,000. The total gain would be 40,000. Okay, how much gain can we recognize? Okay, we've already said we lack commercial substance, but we are receiving some boot. We're receiving some cash. Well, here's how we do that. What's the amount of boot we receive? We receive $10,000. Well, we divide that by the amount of boot of 10,000 plus the fair value of the, let me see here. Let's see here. Okay, let's remember what our formula is. Let's go back. Let's go back a slide. Just to remind ourselves what this formula is. We're going to take the cash received, the boot, divided by the summation of the cash received or the boot, plus the fair value of other assets received, not given up, but the fair value of other assets received. What is the fair value of the other asset received? We're exchanging it. We're receiving a machine with a fair value of 90,000. So when we go back to our formula, we take our boot of 10,000 divided by our boot of 10,000 plus the fair value of the asset received of 90. That's 10%. 10,000 divided by 100,000 times 40,000, and that means we can recognize a gain of $4,000 on that situation. Okay, so what we would do here is right here. Okay, here's the order I would do these in. Okay, how much cash did we get? They gave us cash of $10,000. We got to take our old machine off the books. We have to take the cost of it off our books. We have to take the accumulated depreciation off the books. we just calculated how much gain we're able to recognize. Now this is a situation where we lack commercial substance, but we are receiving some cash. Now if you lack commercial substance, but you're receiving some cash, you can record a partial gain, and that's what we're doing. We calculated from the previous slide that we can recognize $4,000 gain. So this right here is the plug. We record the new machine at whatever we have to make that journal entry balance. Okay. Now there's other ways you can calculate that as well. You can take a look up here if you'd like, but either way, the basis of the new machine, or what it goes on the books at, is $54,000. I like to just build the journal entry, like I said, in the order listed, and then knowing that this is a plug. Okay? This was again a situation where we received where it lacked commercial substance, but we did receive some cash. So in that sort of situation, we can recognize a partial gain. This is a nice segue into our summary. Okay, we're almost done, folks. Summary. Okay, we're going to compute the total gain or loss for the transaction. Okay, now if we have a loss, you can always recognize the loss, whether it has commercial substance or not. Now, if we have a gain though, and if it has commercial substance, you can recognize the gain. You can do it. If the exchange though lacks commercial substance, if there's no cash involved, we cannot recognize a gain. Okay? And if it lacks some commercial substance, and if we had to pay some money, that's another situation where we cannot recognize the gain. The only time, if there's a gain and it lacks commercial substance, that we can recognize a partial gain is if we received some cash. Okay? If we received some cash. And then we compute that as follows. Okay? I know that this is all one of the trickier things that we have gone over. Okay? But if you remember this slide, remember, you can always recognize losses. You can only recognize gains if it has commercial substance. If there's a gain and it lacks commercial substance, then you've got to start analyzing it down here. Okay? I think as you work through these on your homework, it'll start to make more sense. But you might need to watch this video again. I know it's one of the longer ones and one of the more complex ones. Okay? But I know you guys can do it. Thanks a lot. Bye.